Right, good afternoon, everyone. Thank you, Marie Money, for inviting me to speak here in Busan and take part as the last panel of the day. What I thought I would do to sort of get us into the mood for this last panel, which hopefully covers a lot of interesting areas, draws together some of the topics that we've been discussing all today, is show a few slides. Anyone that's seen me before knows I like a slide. And what I thought I would do to start off with would just show just one macroeconomic slide, just to highlight 2 points really. The first point I wanted to raise relates to the chart on the left-hand side. Basically, the big Western economies over the course of the last 12 months have actually done better than most people expected. The chart that we can see here is basically consensus forecast for GDP taken each month from the start of 2022 right through to the current date. And you can see at the start of 2022, people are expecting 2023 in both the US and the Eurozone to be about 2.5%. This time last year, things had got, the storm clouds had grown, inflation was on the up, interest rates were going up in tandem, and people were very much talking about recessions. However, over the course of the last 8 months or so, things have turned out a lot more rosier than pretty much everyone had expected. We're now expecting the US to post around 2% year-on-year GDP growth. Europe, not quite as good, but still, recession hasn't hit in the Eurozone. On the right-hand side, however, things have not necessarily panned out the way we thought they would do in China. The chart here just shows the components of China GDP. We thought as China came out of lockdown that we would see a big bounce back. We did in a lot of the sort of drivers of Chinese GDP macroeconomic environment, but not in the real estate and the infrastructure side. That has languished somewhat and has had an impact on the shipping markets. So coming to the shipping markets, I just wanted to put one slide up on demand, trying to summarize what we've seen on the demand side across a range of shipping sectors and commodity types. And we can see the bar here, that the yellow bar is 2023. We compare it against last year, 2022, our forecast for next year in 2024, and the annual average for the last decade. We can see for all the energy sectors in 2023, the markets from a demand side perspective has performed favorably. If not above historical levels, certainly above 2022. We've seen some weakness in some of the dry bulk, the container ship sectors, but generally the demand side of the equation has performed. The other side of the equation, of course, the supply side, and this is where we have some concerns if we put some of the sectors under the microscope. The chart on the left shows you the build-up of the order book compared to the fleet, both at the end of 2019 and at the end of Q3. And we can see some very stark numbers coming from this chart. The LNG carrier sector, the order book now represents around 50% of the actual trading fleet. Container ships, over 25%, car carriers, 30%. Those sectors appear to be very overexposed from an order book perspective. Crude tankers, products, dry bulk carriers, however, we're seeing the order book in low single-digit territory, a good sign for fundamentals going forward. Now, with the supply side of the equation, we've always got the safety release valve of scrapping, and the fleet is getting older. A lot of those vessels that were ordered during the first decade of the century are now coming to sort of the phase where they could possibly scrapped. And as we can see from the charts here, pretty much across the board, everything is sort of entering its teenage years or above on average. So where are we on the earnings cycle? This is a schematic that I like to put up to try and encapsulate everything in one infographic. What we're trying to do here is look at the relative position of each individual sectors to the cycle itself and comparing and contrasting one sector versus another. Now, if we start on the left-hand side of the chart, or the infographic, we can see a lot of those energy sectors. The energy markets have been booming, certainly since last February with the Russian invasion of Ukraine. they have come off the sort of heights that we saw 12 months ago. The fundamentals still remain strong, but the froth has come off the top of the markets. If we move across to the right, we can see the dry bulk and the container ship markets have come a long way off from where they were 2 years ago. They're not at the floor yet, but they're approaching it. We expect to see that in the next 12 months or so. Moving to the sort of upward hills of the cycle, we can see offshore. Offshore's had a very good run over the last 12 months. We still think there's some runway left for them to improve yet further. And at the very top of the pile at the moment is the LPG market, and specifically the VLGC sector, which has benefited both from inefficiencies associated with the Panama Canal, but also the imports of propane into China to feed PDH plants. When it comes to profitability, if we look again across all sectors, apart from dry bulk, everything currently looks profitable. And by profitability here, what I've measured is the break-even level. So that's bank debt service, the daily operating cost, which are the stacked bars, and the red line is the one-year TC rate. So the moment you've got white between the stacked bar and the red line, there's profit. Profit to pay shareholders, profit to pay equity, and other forms of finance. So apart from dry bulk, currently everything is making profit. But asset values, I would say, would remain sticky regardless of the sector. And here we can see a comparison of asset values as they've developed over the course of this year against the last couple of years and some historical envelopes. We can see that the tanker sector asset values are above and beyond anything we've seen very recently in recent history. But even for dry bulk, even for container ships where earnings have come down huge distances from the sky highs that we saw, say, at the start of 2022, the asset values are at or above historical levels. But of course, I mean, it's formed, and this is no surprise, a lot of the conversation today, and as it does at every conference, at every meeting, I'm sure in the shipping industry now, regulation and ESG and compliance and market-based mechanism to reduce emissions are coming thick and fast. And the industry is going to have to deal with it, and this is, in addition to the fundamentals, we're now having to talk about a third leg of the prop, as well as supply, demand, its regulations. And in our view, this is our forecast on the left of the global fleet development by fuel type. We do expect to see more and more vessels being built with dual fuel capability. We do have concerns that there won't be enough fuels, green fuels, to enable these vessels to run on the green alternatives. So a lot of these vessels will be running heavy fuel oil derivatives, certainly by the end of this decade. But as you can see, methanol and ammonia will be the fuels of choice as we move forward. And unfortunately, based on our forecast for contracting, the renewing of the fleet, we don't think, as it stands, the industry will reach IMO's 2050s net zero new regulatory requirements. As you can see, there are still some vessels in the fleet that will be burning oil. So then we need to start looking at things like biofuels and carbon capture to really try and hit that net zero by 2050. So those are all the slides that I prepared. Hopefully that's a broad range of subjects that will help perform a catalyst for our conversations as part of the panel.
Good afternoon, ladies and gentlemen. It's on behalf of myself and the wider Stephenson Harwood team, I'd like to just say it's great to be back in Busan in Korea. We're quite proud of the work that our team does in this jurisdiction. So, this event is one of the highlights of our year, and it's great to be able to be back and reconnect with friends, clients, and colleagues. I'd like to reintroduce our esteemed panel today, Dr. Adam Kent, Mr. James Lawrence, and Mr. Tom Zachariassen. Thank you very much, gentlemen, for agreeing to speak today. So the theme of our panel is challenges ahead, but shipping remains confident. So I think what I'd like to try and get through today, I mean, it's a topic that lends itself to a wide possible range of discussions, but I think three broad themes, maybe an initial reflection on this idea that shipping remains confident, and then trying to unpack some of these challenges, and then as a third sort of theme, looking into some strategies and solutions. So maybe the first question for James, kind of reflecting on Adam's presentation and your own observations, how do you reflect on this idea that shipping remains confident?
Well, I'd like to start by paraphrasing something that Standard Chartered's Abhishek Pandey said yesterday, which is, it's no longer just about supply and demand. Today, it also depends on what decarbonization strategy one chooses and what actions you're taking today. And I think that's a kind of a wise, broad picture of how the industry is evolving. However, looking at some of Adam's slides, I would be remiss in saying that supply and demand in sectors like container ships or car carriers or even LNG vessels aren't something that the market out there is taking a view on.
Thanks. Maybe a similar question for Tom, but from a financier's perspective, how do you capture this moment in time? And in the context of these challenges, what segments of shipping do you as a financier see as attractive?
Thanks, Matt. I think we are, the good thing is that we are in a very robust setting, if you look back in a historical perspective. And we've had some good years now in shipping, and most shipping markets have experienced an upturn over the last 3 to 4 years. And even the offshore sector is now seeing that. So that puts everyone in a good starting position. Companies have deleveraged or repaired their balance sheets after some tough years prior to that. Although, as Adam shows on his slides, there are some clouds on the horizon for certain segments, we are probably better prepared this time around than in previous years. And I think the lenders are also a little bit more clever this time around, and they've been around for a long time, and they wouldn't pull out so easily. There is, of course, a lot of lenders that are balance sheet focused. They look a little bit beyond the spot market or beyond the short-term markets. As long as the companies follow a good strategy, I think you will see lenders continue at least for a few more years to support these. And to some extent, I would say European banks have become a bit more pro-cyclical in their lending rather than counter-cyclical. And that's basically down to regulations and how they are driven by internal rating solutions, etc. And then we've also seen a number of asset-based lenders coming back into the industry in recent years, to some extent to cover the gap that some bigger banks have left. And of course, we also do have a wide range of alternative capital providers, whether that's Chinese leasing or Western alternative capital providers.
Thank you very much. So with that in mind, I thought it'd be worth kind of diving into some of these perceived challenges in the market right now. And I know we've talked a lot about ESG and fleet renewal and the need to go green, but perhaps a question for Adam is, we've heard today about, particularly in some segments, an aging fleet. How do we reconcile the current high inflation, high interest rates, which would seem to be an objective or an obstacle to fleet renewal and investment, with the need to take that investment and make strides forward?
Hello. It's a very good point, and I think you can look at it from two ways, really. I mean, if we've seen high interest rates, we've seen high inflation now, as I said in my presentation, at least for the last 12 months or so. And if you look at how many vessels have been ordered over the last 12 months, it certainly hasn't put some people off. I would say that for those speculative speculative orders, smaller vessels, smaller owners, they're probably putting things on ice for the minute. But that goes hand in hand with the decarbonisation, the lack of uncertainty of fuel types, technologies, and the availability of fuels. From our perspective, looking at our forecasts for inflation, we expect inflation to sort of come off back to sort of historical levels within the next 12 months. We expect interest rates to come down to around 2.5% within the next 18 months. So we do see this as a relatively short blip. But we do expect to see continued orders for dual fuel vessels, especially where there are cargo contracts in place. And I think that, that sort of emanates what we've seen over the last 24 months. A lot of the contracts that have been placed for the LNG, for the container ship sectors, have been backed by contracts. So I think, yes, that is presenting a headwind, but I think certainly for the larger players, they're still prepared, because they're still sitting on, a lot of them are sitting on cash, as we've been already heard. They will place those orders.
Super, thank you very much. Interesting, because there was a phase a couple of years ago where, the issue of inflation, we were looking at certain deals that we were looking at, and we were wondering, are inflation adjustment clauses going to start needing to be built into shipbuilding contracts, because it was getting quite out of hand, particularly when, ships are ordered for so many years in advance. But yes, very interesting. Perhaps question now for James is, we've seen a whole menu of geopolitical issues. You can almost take your pick between the kind of post-COVID period, the Russia-Ukraine war. Looking at some of these geopolitical issues, do you get a sense that there'll be a return to the way things were, or are we in a new status quo, and how do you think shipping companies need to adjust?
Matthew, thanks. I will say, having been on the road for the last 3 weeks, it's one of the joys has been I've not watched television news. But when I left New York 3 weeks ago, the world did feel a scary and somewhat unsettled place. That said, the tone of the conversation today, with the very optimistic, I think, views of the transition, how it might actually happen, mirror what I heard in Athens last week and the week before. The Global Maritime Forum was particularly optimistic about, being able to sort of make the transition and keep things moving forward. So I think my takeaway is I'm not going to watch television news when I get home, and I'll leave the questions about whether things will change or go to a new normal to brighter people on my left and my right.
Tom, do you have any views on the subject?
Yeah, I think when it comes to decarbonization, I think we've shown that the industry cares, the ship owners cares, and I think they want to drive decarbonization. So I think we are. I'm optimist, because we are pulling in the same direction from the ship owner's point of view, from the technology point of view, and from the financiers' point of view. And then sort of on a little bit side on the geopolitical issues, and clearly we've seen that there are certain additional risks, and as been said earlier today, and we've seen certain lenders pulling back on back leverage for Chinese leasing. We've seen European, maybe particularly European borrowers being a bit more conservative when it comes to going to China for Chinese leasing deals. But at the same time, I think we are adjusting the course. We're not changing it completely.
The next thing I wanted to kind of consider was this concept of deglobalization and market fragmentation, which is beginning to sort of appear in economic commentary, and different people have different views on the subject and how it's affected things like changing trading routes as stakeholders look to de-risk and reshore and find comfort in trusted partners. Adam, maybe in terms of changing trading routes and allegiances and alliances, do you see this playing out, and do you subscribe to this idea that we're moving towards deglobalization?
It's if we just talk about China to start off with, and perhaps the container ship industry, I think it's, China has positioned itself as the manufacturer of the world, and I think it's going to be very, very difficult to sort of move China out of that number one spot for some time to come, just because of the supply chains that are associated with that manufacturing process. That being said, we are starting to see some movements to sort of near-shoring, friendly shoring, whatever you want to call it. I mean, if you just look at the numbers, I was looking at some of our container ship numbers. We look at the growth in container ship exports from Vietnam, Thailand, India to the US. From 2019 to 2023, they've gone up by between 20 and 40% over the course of the last 3 years. From China to the US, they've actually gone down by around 10%. Now, some of that will be sort of increasing the diversifying supply chain. Some of it also comes back from the tariffs, the US-China tariffs that were implemented before COVID, which everyone seems to be forgotten about. COVID itself also made economies want to bring supply chains close to home. I also think one of the interesting dynamics as we move forward will some manufacturing move towards green fuel production and green energy production. So, we're talking about places like North Africa, Chile, Australia, the Middle East being the hubs for green energy production, either through wind or through solar. Now, it may make a lot of sense to start moving production of goods and manufactured goods to some of those regions, especially for sort of very energy-intensive processes. So yeah, I mean, that's moving, and of course the Russian invasion in Ukraine pretty much ripped up the energy market trade routes overnight. And the remarkable thing, both with COVID and with what we saw last February, that shipping is very, very resilient. It almost sort of overnight changed trade routes, changed trade lanes. Governments, companies changed trading partners. So I think shipping is very resilient, shipping is very elastic, and shipping does manage these market geopolitical risks, which have existed from day one of shipping.
Thank you. And then maybe now looking kind of what we can do to deal with some of these challenges. And we talk about the high interest rates and the possible barriers to funding that may present. And perhaps a question for Tom is, in this context, how important is, policy, state intervention, the kind of governments and policymakers taking positive actions to kind of share that risk? And perhaps connected to that is, taking Korea as an example, looking at the support that institutions like KDB, KEXIM, KOBC, and other policymakers offer shipping. Are jurisdictions like this at a strategic advantage when it comes to dealing with these issues of high interest because of the support they receive?
I think clearly government support or government intervention is a clear enabler in when we come to the decarbonization pathway. And as an industry, I think we should make our voices heard on that, and in fora like this or the Global Maritime Forum. We need guidelines and regulations to help us on that, and we also need funding solutions or funding support for that. At the same time, I do think the financial industry will also adopt very much and very quickly to that pathway, they will work hand in hand with government institutions, with policy institutions, like we have here in Korea, for building, particularly for the building of new ships. Then, sort of to your last question or comment, the Korean policy institutions have a clear positive impact and can do, as we've seen on some of the slides today. Green is really on their agenda. They might not be Poseidon Principle members, but they do provide important funding, particularly for the ship, the new shipbuilding, which will of course be greener than our existing fleet. I hope they can do more. I hope they can also support in retrofitting ships, and not just for the Korean owners, but also in the international market. But yes, there is an advantage for Korea to have such a strong backing of the policy banks and institutions. Let's hope it's not too good, that it becomes an unfair playing field. But yeah, it's always good to have that backing.
Thanks very much. Maybe another question for James is, looking then at kind of the long-term challenges facing shipping, do you have any views on whether shipping companies might have to really look at their overall strategies, whether that be diversification of shipping segments or looking to expand their business into wider aspects of the supply chain? Maersk, for example, no longer describe themselves as a shipping company, but as an end-to-end logistics company. Do you see that sort of strategy having to become important to kind of long-term success and survival?
Yes, but I kind of qualify it in sort of with three sort of segments. And Maersk, by the way, I was found this out in Greece. They actually own now their own fuel development company. But anyway, I think there are three characters. Thinking that reminding everybody that I come from New York. I think for the private owners, I would be trying to take some money off the table now until there was a bit of clarity. I would be buying real estate or setting up trusts for my grandchildren's future education. If you're a publicly traded company in New York or London or Norway, you've got a bit more of a challenge because your investors have bought you because you're a VLGC owner or you're a container ship lessor. A little harder to sort of close up shop and wait for the market to kind of come along. But if you're a VLGC owner with 22 ships, you've got to basically replace one a year, so you're going to have to go through the cycles. And then with the Maersks and the MSCs, yes, you've described it perfectly. They're going to just continue to diversify. The question that I would have for Adam and for Tom would be, 15 years from now when we're here, what will those owners, those family owners of 6, 8, 9, 10 ships, what will they actually look like?
Let me answer my question, then I'll have a think about Jim's as I answer my question. I was just going to add to that. The one thing that I've certainly noticed in talking to owners is people are, I guess they're hedging their bets a bit. They're looking for flexibility in assets. Whether that be you're ordering an LR2, so you've got a coated Aframax that enables you to trade crude or products, whether you're ordering or you're buying a PSV and you're putting a crane on the back so you can do construction work, or even in the case of VLGCs, we're now seeing VLGCs that are being built that are ammonia capable. VLGCs historically haven't carried ammonia, but these people are placing a bet on the fact that the green ammonia trade routes will open up and we'll need VLGCs because we're going to be moving ammonia over larger distances. So I think flexibility is increasingly becoming the key. Even if there's a higher capex involved, you're sort of buying yourself an insurance policy going forward. I think in terms of Jim's point, it's an interesting one, and it's one I know that people have talked about for even before I joined shipping, and perhaps I've not been, no offence, in shipping as long as Jim, but I've been in it for over 20 years. Consolidation. I think with the dynamics that we're currently seeing within the market, whether that be from a finance perspective, a digitalization perspective, access to cargo, I think a decarbonisation, access to fuel, a lot of these products, a lot of these avenues are only going to be open to the biggest players within the industry. So we've seen it already happening in the container ship sector for slightly different reasons. We're obviously looking at something going on or has gone on recently on the VLCC sector. So I do think that this could be one of the the artifacts of all the moving parts that we're seeing that may only be available for the largest players, that we would potentially see more consolidation in the market as we go forward. I'm not sure if that answered your question, Jim, but...
I'm being reminded that we have a couple minutes left, so maybe just to wrap up, the sense I get is that there's cautious optimism amongst the panel, but perhaps as a final closing set of remarks, if I could give everyone a magic wand and grant one wish to deal with these upcoming or potential challenges, what would each of our panel members like to see, perhaps let's say in the next 12 months, to deal with some of these issues?
Good thing that you gave me a magic wand. Jim wanted to give me a crystal ball. I think for me, it's very much around the decarbonization and that we, of course, continue on this path. And to Adam's last point, I think that's also why there will continue to be the consolidation to meet some of these stringent requirements. But I think my call it top wish is effectively a global carbon tax being implemented in a sustainable way over the next few years, because that will enable us to move in the right direction. It will help companies to take a bigger step into ordering really new not necessarily zero emission ships, but lower emission ships, rather than just the dual fuel ready or the ammonia ready, where we take the full step. So I think carbon tax is my comment.
Just very quickly, I would note that not just now, but throughout the meetings in Greece 2 weeks ago, there was an enlightened and progressive sort of acceptance and even a call for a tax or legitimate regulations to help the industry make the economic decisions. I think if I were to say what I wish for, I would like to be back here next year taking the optimistic presentations that we heard from the policy banks, their initiatives in the green space, and knowing that 17 years ago when we started this event, it was on the heels of Lehman and the financial crisis, and Chemco had just been established to help sort of salvage the Korean industry, and today they're making sort of mega transitional sort of changes and investments. So I'd like to come back next year and see just how far they can carry us.
I guess I'll finish with more decarbonisation. My wish would for there to be a level playing field in terms of regulation and level playing field and clarity of what's going to go on in the future. I mean, we're still sitting here. We don't know what CII is going to look like come 2026 and beyond. They've set the limits up to 2026. We don't know what the trajectory thereafter is. Once you've got clarity, once you've got a level global playing field, you can then have a serious conversation between an owner and a charterer about charter rates, long-term charters, fuel availability. At the minute, there are just too many moving parts to have a sensible conversation and people to put their own money on the table to enable that to be enacted.
Thank you very much, gentlemen. I think that's time for us. Very, very enlightening conversation, and thank you for your time.